Okay, when you're buying or selling a business, let's be honest, everyone focuses on that one big number, right? The sale price. But there's this hidden figure, a super crucial detail that almost always gets overlooked until it's way too late. We're talking about working capital. And it's the absolute key to making sure a business sale is actually successful long after the ink on the contract is dry.
So let me just ask you this. What do you think is the #1 reason a business deal completely unravels? Not during all the back and forth negotiations, but after the new owner has the keys. It's not what you think. It's not a bad product. It's not a sudden market crash. No, it's something much, much more fundamental.
And the answer? It's a lack of sufficient working capital. Yep. It's kind of like this silent problem that just lurks in the background of a deal, and then it roars to life the second the new owner takes over, creating immediate, and I mean immediate, financial stress.
And here's where it gets really scary and really tangible. Just imagine this for a second. You've just bought your dream company, you walk in on day one and you realize you can't pay your employees, or you can't pay a critical supplier, and your whole production line just grinds to a halt. This is not some theoretical risk, you guys. It's a real-life cash flow crisis that can kill the business from the very start. And that's exactly why we call it the hidden deal killer. Because while everyone's obsessing over the valuation, this is the thing that really determines the day-to-day operational reality of the business after the sale. And believe me, it affects everyone at the table. Let's just quickly break down what's at stake here. For buyers, the risk is pretty obvious, a massive cash crunch right out of the gate. For sellers, look, if you can't prove that the business has enough cash to run itself, it completely undermines your value and your asking price. And for brokers, it's a total nightmare scenario, trying to hold a deal together that's just falling apart because of a completely preventable problem.
So, now that we all understand the problem, let's get into the solution. And it all starts with really, truly decoding what working capital is, and way more importantly, what it actually does for a business.
You know, in the simplest terms, working capital is the lifeblood of a business. It's not profit, it's not revenue, it's the actual cash you have on hand to manage the day-to-day operations. You know, paying bills, buying inventory, making payroll. It is a direct measure of a company's financial health and its stability.
The best way to think of working capital is as a constant balancing act. On one side, you've got accounts receivable. That's cash you're waiting on from your customers. And you've got inventory, which is basically cash tied up in products you haven't sold yet. Then on the other side, you have accounts payable. That's the cash you owe to your suppliers. And managing the timing and the balance between all of these, well, that's everything.
So how do we measure this interplay? How do we get a handle on it? Well, we use this really powerful tool called the cash conversion cycle. This is where we go from just a simple definition to a really dynamic understanding of how cash actually flows.
And this visual just illustrates the whole concept brilliantly. Look at the flow here. Over on the left, cash goes out the door when you pay your suppliers. Then there's this period of time, that's the cash conversion cycle, where your money is just stuck. It's tied up. It only becomes cash again way over on the right when your customer finally pays you. The whole goal is to make that green bar, that cycle, as short as humanly possible. And believe it or not, the formula to calculate that time gap is surprisingly simple. You just take the number of days your cash is tied up in inventory, or DIO, you add the days it's tied up waiting for customers to pay, that's your DSO, and then you subtract the days your suppliers give you to pay your bills, the DPO. The result is your cash conversion cycle. And a little pro tip, a lot of businesses find their quickest win is by improving how fast they collect from customers, that DSO number, or by negotiating just slightly better payment terms with suppliers to stretch out that DPO.
Okay, so that's the theory. But how do you turn that cycle time into a hard number? A specific working capital target that you can actually use in a negotiation? Well, it's actually a pretty straightforward two-step process.
Getting this right is so important, and it's simpler than it sounds. First, you just figure out your daily cash outflow. This is the average amount of cash the business spends every single day just to operate. Think payroll, supplier payments, rent, utilities, all that stuff. Then, you simply multiply that daily number by the length of your cash conversion cycle. That's it. That is your defensible, data-driven target.
All right, to see this in action, let's take a look at a case study. We've got Riverside Auto Repair, a really profitable shop that's being prepped for sale. Now, the broker here needs to calculate a very precise working capital target to make sure the transition for the new buyer, Mike, is completely smooth.
So after running the numbers, this is what they found.
The business has a daily cash outflow of about $5,700, and its cash conversion cycle is just under 13 days. You multiply those two numbers, and you get a specific, totally defensible working capital requirement of $72,706. This is the amount of cash that needs to be in the business at closing, period, to make sure operations continue without a single hitch.
And having that number, that specific, calculated target, is what completely transforms the conversation. It moves everything away from guesswork and ambiguity to a clear, data-driven negotiation. And that benefits everyone involved and really paves the way for a super smooth transaction.
When this is done right, the benefits are crystal clear for everyone. Brokers can lead a really transparent negotiation. Sellers can confidently justify their valuation and give the buyer genuine peace of mind. And most importantly, buyers can step in on day one knowing they have the cash they need to operate successfully and avoid any of those immediate financial risks.
So ultimately, this is the key takeaway. If you remember one thing, let it be this. Working capital isn't just some number on a spreadsheet. It is a direct reflection of the operational health, the pulse of the business. It's the engine room of the company, and making sure it's properly fueled is the real secret to a truly successful sale.
Which brings us to the final question you should be asking yourself, whether you're a buyer, a seller, or a broker. Is the working capital target in your deal built on confidence and clear calculations, or is it built on guesswork? If you want to make sure it's the former, well, this explainer is really just the beginning. In our full webinar, we dive so much deeper into these tools and strategies to make sure every single transaction you're a part of is set up for success.